Good afternoon and welcome to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. And joining me live at Nasdaq HQ is Mark Cool, is a co-founder of SplitRock Private Trading and Wealth Management. I'd like to thank you very much for joining us at headquarters this morning.
Thank you for having us.
All right, it's quite the trip coming in from northern Minnesota, huh?
Yeah, it was a good trip. I got a text last night, we got some snow. So we dodged the snow coming here, and we'll head back to the snow when we go home.
Well, let's hope you keep it there and not in New York City. But before we get into our topics today, give us a little bit of background on SplitRock.
Yeah, SplitRock Private Trading is an investment advisory firm located in Duluth, Minnesota, which is about 2 hours north of Minneapolis, St. Paul. Along with my business partner, Tyler Koken, we founded SplitRock about 8 years ago now, right on the tail end of the 2008 financial crisis. We consider ourselves at our best when the market pulls back or we see extreme volatility. And the reason why has a lot to do with our history. Prior to SplitRock, we spent 10.5 years managing money for corporate America. We started in May of '99. We had 10 great months. Every stock we bought skyrocketed. We looked brilliant. And then we ran face first into 2000, 2001, 2002. So the tech wreck and obviously 9/11. We got through those 3 years, very long and hard 3 years. We had 5 great years, and then 2008 came. And that was, as everybody remembers, that was a tough time, very stressful. And if the stress wasn't enough getting through that, we decided to create SplitRock. And because of those first 10 years, today we're a little bit more of a conservative firm, and we just feel that if you can take care of the downside with your portfolios, the upside usually takes care of itself.
That's something I wanted to ask you, because a question that we address on Trade Talks is, for example, there's been an enormous run in the markets this year, 20% on the S&P, 25% on the Nasdaq comp, particularly with the FAANG stock participation. How do you manage it over at SplitRock?
Well, how can you not love the FAANG stocks? We talk about Facebook, Amazon, Netflix, and Google. Amazon and Google last night, looks like they report some earnings. They're having a good day today. If you look at the chart of those four, if you chart them out for the last 2 years, it's absolutely incredible, their returns. Of those big four, we're probably bigger fans of Amazon and kind of what they're about. Obviously with Amazon Prime and Amazon Music and video. We're excited to see what happens with the Whole Foods acquisition. And literally every morning when I wake up and I'll read what's going on in the market, it seems like they're always getting into something, whether it's they're going to have their own pharmacy or pharmaceuticals, whether they're going to start delivering fast food in certain big cities. It's just scary. But one thing that I think we could all agree on is what Amazon has done is they have completely raised the bar when it comes to e-commerce and online shopping. So whether it's a Walmart or a Target or Best Buy or any other traditional brick and mortar, those companies are going to be forced now to start upping their game when it comes to the online experience. And so, one way that we have kind of indirectly played on Amazon is we'll let all those e-commerce online shopping companies beat each other up. Well, those packages have to get to your front door. So there's only a couple ways that they actually get to your front door. So you could look at companies like a FedEx or UPS. I know FedEx has spent a lot of money to make sure that their systems are integrated with Amazon. UPS, I think, is starting to do that now. UPS, pays a nice dividend. But, at the end of the day, those packages have to get to your front door. We'll let those big companies beat each other up, and we'll piggyback off, a FedEx or Amazon. And we do think that's a secular trend, and that's something that's not going away at any time soon. Well,
despite the fact that there has been a record run over the past 2 years in equities, there is some volatile stocks, particularly in the tech space, that it is just what it is. So, for example, I know you guys have some strategies around Tesla.
Correct.
For example, they just are volatile stocks. How do you manage that?
Yeah, you know what? And Tesla has been a name that it's been a love-hate for us the last couple of years. And it literally seems like every month Tyler and I have a discussion about Tesla and, should we add it to our portfolio? Should we not? And finally, March of 2016, so a year and a half ago, Tyler, myself, and Kelly Johnson, another member on our investment council, sat down, for hours and just peeled back the layers of the onion on Tesla. And we fundamentally just couldn't buy it. But when you're researching it, one thing that you do realize right away is that it's amazing the push and the attention that the electric cars are getting. So whether it's Tesla or the Toyota Prius or the Chevy Bolt or Volt or the Ford Focus, what is that common denominator? Well, it's lithium batteries. And the one thing nice about lithium, it's also in your cell phones, your Fitbit, power tools. And when Tyler and I got here last night, and we're walking around trying to find something to eat, it was incredible as how many pedal bikes we saw zipping by us when nobody was pedaling. Well, those aren't powered on a banana peel like Back to the Future. It's a lithium battery in there. So there's 3 companies that basically control 90% of the lithium, in the world. And 2 of the 3, we really like, Albemarle, ALB, and then FMC. What's nice about FMC is they're talking about spinning out the lithium side of their business next year. So that would be a pure lithium play. But Albemarle's getting a lot of headlines here, in the last couple months, and we've been lucky enough or smart enough, hopefully, to own that for the last year and a half. And again, like FedEx, UPS, we feel that's such a secular trend and a decade-long trend that it's worth paying attention to. All
right, let's wrap it up with this. At Split Rock, you take a more conservative approach regarding volatility.
Yeah.
What does that mean?
So the sectors and the companies that we just talked about are obviously fun and incredible, when times are good. But our bread and butter are going to be a lot of consumer staple type companies or even high dividend paying companies, and that does have a lot to do with our first 10 years and going through those 2 awful bear markets. Those stocks are not sexy and at times are rather boring. But if you take the time and chart out the consumer staples index versus the S&P, it is absolutely incredible to us how much it outperforms it and how the downside is much less. So we are just convinced that when we see, I should say, the next 20 to 30% pullback, or heaven forbid a 2008, which none of us want to see, a couple things. When the market dips, a lot of those companies, do pay a dividend. You'll get paid to wait for the stock price to come up. And then, at the end of the day, nobody is going to stop shaving their face or washing their hair, putting on deodorant, or buying diapers for their babies, or even having a diet Mountain Dew or a bag of Doritos. And so, we just, like I said in the beginning, we are a much more conservative firm because of those first 10 years. And creating wealth in the stock market a lot of times is just kind of like that tortoise versus the hare. And to be honest, we're okay with being the tortoise.
Right. Okay. Well, thank you very much for joining us at HQ. And traders, as always, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.